NEO just delivered one of the cleanest technical breakouts I've seen in years. And right now, the question everyone is asking is whether this stock is about to explode into a double squeeze setup that sends it to price targets most retail investors haven't even dreamed of yet. Today, I'm going to show you exactly why the setup we mapped out last week played out almost to the cent, what the smart money is quietly doing behind the scenes, and precisely where NEO is headed in the week of February 23rd through February 27th. We're talking institutional floodgates opening, a gamma squeeze mechanic coiling tighter by the day, and a fundamental pivot that just turned one of the most controversial stocks on the market into something Wall Street can no longer ignore. Stay locked in, because this one is going to move fast. But before we look ahead, let's talk about how we got here and why this validation matters more than you might think. Last week, I set a very specific challenge for the bulls. I told you that for the bull case to stay alive, NEO had to defend the $4.73 support level and reclaim the $5 psychological barrier. And what did the market do? It followed our script almost to the cent. We had identified an entry zone between $4.95 and $5.05. And even as the news cycle turned ugly, with a massive 246,000 vehicle recall hitting the wires, the stock showed remarkable resilience. Price memory doesn't lie. Structure doesn't lie. And this price structure told us exactly where the floor was. Now here's the question you should be asking. How does a stock barely flinch on news that would have sent most companies into a freefall? On February 19th, NEO hit an actual intraday low of $4.82, comfortably above our $4.73 Death Valley floor. Think about what that means. A major software recall, headlines screaming, retail investors panic selling, and yet the price didn't break. That divergence between negative news and stable price action is not random. That is what happens when the biggest, most sophisticated capital allocators on the planet are actively absorbing every single sell order that retail throws at them. They aren't just watching this stock, they are defending it. And once that defense was solidified, NEO did exactly what we said it would do at the $5 level. On Friday, February 20th, NEO shattered the $5 ceiling, surging to an intraday high of $5.13 before closing strong at $5.07. That close above $5 is not just a number. It is the ignition switch for what I'm calling a bullish feedback loop. Momentum traders start buying, algorithms trigger, short sellers start sweating. But here is what most people watching this video still don't understand. The technical breakout is actually the least exciting part of this story, because NEO is no longer the company the bears have been betting against. For years, the narrative was simple. NEO burns cash, NEO has negative margins, NEO is a speculative startup with no path to profitability. And for a long time, the bears weren't wrong. But we have officially crossed into a new chapter. The cash bonfire phase is over. What we're looking at now is a profitable energy and technology network, a company that has built an infrastructure moat so deep that competitors would need years and billions of dollars just to attempt replication. This is a structural pivot, and the market is just beginning to price it in. So what does the actual data look like? For the first time ever, management is projecting an adjusted operating profit for the fourth quarter of 2025, estimated between $100 million and $172 million. Let that sink in. They aren't just slowing the burn rate, they have flipped the switch entirely. With projected delivery growth of 40 to 50% over the next 2 years, NEO is on track for full-year adjusted break-even in 2026. The bear thesis just lost its most powerful argument. But what if I told you the physical side of this business is growing even faster than the financial side? On February 21st, NEO's battery swap network hit a historic single-day record of 175,976 swaps in a single day. That is one swap every 0.5 seconds. Every single swap is a recurring revenue event. Every single swap deepens the lock-in of NEO's customer ecosystem. When your network usage goes parabolic, it tells you something the income statement hasn't fully captured yet. And smart money reads that signal before it shows up in the earnings report. Speaking of smart money, let's talk about who is actually buying this stock, because this is where the story gets extraordinary. Recent 13F filings reveal that D.E. Shaw and Company has more than tripled its stake to nearly 48.2 million shares, officially becoming NEO's largest institutional shareholder. JPMorgan Chase increased their position by a staggering 268%. BlackRock jumped in with a 153% increase. These are not Reddit traders. These are not diamond hands hoping for a lucky bounce. These are the most disciplined, data-driven capital allocators on the planet, and they are building massive positions at the $4 to $5 level right now. And here's the part that should make every short seller nervous. Institutions now control nearly half of the total float. When the smart money locks up that much supply, the mathematics of price movement change completely. The available shares shrink. Any meaningful increase in demand has a magnified, and I mean dramatically magnified, effect on the price. What happens when retail finally catches up to what institutions already know? Wall Street is starting to wake up too. The consensus analyst target has moved to $6.83. Citigroup is maintaining a buy rating with a target of $6.90. Macquarie just upgraded the stock to outperform. But some fair value models based on future cash flows see a path all the way to $18.27 per share. At current prices, that implies NEO is trading at nearly 73% below fair value. Could the most hated stock in the EV sector actually be one of the most undervalued setups on the entire market right now? Now let's talk about the mechanical trigger that could send this thing into overdrive next week. There is a massive concentration of nearly 38,000 call contracts sitting at the $5.50 strike for the February 27th expiry. Here is what that means in plain English. If NEO holds above $5.15, market makers who sold those calls will be mathematically forced to buy millions of shares to hedge their exposure. It's not a theory, it's not a hope, it's pure options mechanics, a gamma squeeze, where rising prices force more buying, which forces prices higher, which forces even more buying. The coil is wound, the trigger is the price. And there's another pressure valve about to blow from the other direction. There are currently 141 million shares sold short. With daily trading volume declining, it would take over 6 days for those short sellers to cover their positions. In a low liquidity environment, a sudden price spike doesn't produce an orderly retreat from the bears. It produces a scramble, a panic, a rush for the exits that adds fuel to what is already a technically explosive setup. Can you imagine being trapped on the wrong side of both a gamma squeeze and a short squeeze simultaneously? So how do we actually trade this week? Here is the exact plan. Your buy zone for the week of February 23rd through February 27th is the retest of the breakout between $5 and $5.08. That is your entry. Your stop loss is clear and non-negotiable. Anything closing below $4.73 means the institutional floor has failed and you exit the trade. Our first target is $5.53. That is the critical level where those tens of thousands of call contracts create maximum market maker pressure. If we clear that, the next stop is $6.24, which represents the conservative fair value target. And if this becomes the full re-rating event the data suggests it could be, we're looking toward $8 as the structural target. Now, before we get to the final verdict, I need to share something important with you. Nothing in this video is financial advice. I am not a licensed financial advisor, and everything discussed here is purely for educational and entertainment purposes. Investing in individual stocks carries significant risk, including the potential loss of your entire investment. Past performance and technical analysis do not guarantee future results. Always do your own due diligence and consult a qualified financial professional before making any investment decisions. The options mechanics and institutional positioning discussed are based on publicly available data and my own analysis, which may be incomplete or incorrect. Never invest more than you can afford to lose. With that said, here is the Smart Stock SAM verdict. This is a strong buy setup. The pivot from speculative cash burn to genuine profit generation is now backed by real numbers. The institutional floor is confirmed. The technical breakout has triggered. The gamma mechanics and short squeeze pressure are coiling into a potential double squeeze that the market is not yet fully pricing in. Everything we mapped out last week played out exactly as expected. And next week, the stage is set for the next major move. I'm positioned. The data is aligned. And the question is simple. Are you going to watch this one from the sidelines? Or are you going to be ready when it moves? If this breakdown helped you see NEO through a completely different lens, smash that like button right now. It genuinely helps this channel reach more investors who need to see this analysis. Drop your price target for NEO this week in the comments below. I read every single one, and I want to know where you think this goes. And if you are not subscribed to Smart Stock Sam yet, what are you waiting for? Hit subscribe and turn on notifications so you never miss a setup like this one again. I'll see you in the next video.